Hello, everyone, and welcome to TCA Talks with Experts. Through this program, we would like to interact with various experts from mutual fund industry, try and understand their opinions, views, and thought process about investments and market, and put them into perspective. To discuss with us today, we have a special guest who needs no introduction. She is the youngest CEO of mutual funds in India. She's been very popular on social media. She's been admired for her public speaking and storytelling ability. So it is my pleasure to introduce Radhika Gupta, MD and CEO of Edelweiss Asset Management Company.
Thank you so much, Vasu. It's a pleasure to be here, and your story itself is equally inspirational.
Thank you. So Radhika, we'll just start with. So we are all aware that 2020 has been the challenging year for all of us. The way that we live, the way we interact, the way we work, it has changed. But somehow it turned out to be a very good for investing into equity. So just tell us how was the year gone by for Edelweiss Mutual Fund?
I think it's been a very memorable year. I would say that. I think if you were looking at March 2020, Vasu, nobody could have predicted what we were in for in lockdown one. And there was a sense of doom and gloom and dismality, and we didn't know how we would adapt to this working from home style and what business would be like, what safety would be like, whether food would be available. It's easy to forget all these things a year later. And of course, markets were down. There was a week in the second half of 2020 that looked very, very scary. And, it's all fancy to say I thought it would recover, but I don't think, quite frankly, everyone did. And I think what the year after that has shown you is two things. One is you can never predict markets, right? The sharp crash was followed by an equally sharp recovery and a tremendous stability even during wave two of COVID. I mean, it was an unfortunate wave, but markets were very stable. So I think one learning is that you can never predict. And secondly, you can never underestimate the power of human resilience. I would personally say that I was someone, as you know, who loved to travel, and I thought the business was a very physical business. How will it serve? Even if I can't travel for a week, how will things happen? And we clocked our best year by a mile in our history in terms of equity sales in Edelweiss Mutual Fund last year, at a time when our industry was negative and markets were so volatile. So I think you can also never underestimate the power of human resilience to pick up in a time of crisis.
Superb, superb. And I can see your AUM has grown over 100% in last 1 year. So I still remember during 2020 March, your AUM was around 25,000 crores. Now it is touching 50,000 crores. In fact, it has touched 50,000 crores some time back. So we would like to congratulate you for that remarkable achievement.
Thank you. And I think, AUM is a nice achievement, but what's nice is that the growth has been broad-based. It's been in domestic funds, it's been in international funds, it's been in fixed income, it's been in equities. But our investor base has also almost doubled in the last year. And I think that is the more heartening fact that, we have more than 5 lakh investors who partner with us, and many, many partners like yourself. So I think AUM growth is heartening, but investor growth is even more heartening.
Super. Very great to know. Moving on to our next question. So it is about markets. See, maybe nobody would have thought during March 2020 that we will reach to a point where we are currently. So during March 2020, Nifty was at around 7,500, and currently we are at 15,600. All the wall of worries, and it has touched all-time highs every day. Is it still okay to invest at these levels?
I think, Vasu, the answer is it depends. One is that we don't know what is, it is an all-time high, but it is very, very hard to predict markets. I think you are in a scenario where you are perhaps at the beginning of an economic recovery and sort of the worst of COVID could be over, but you can't rule out things like a third wave. And rising interest rates. So I think markets always have multiple factors shaping them. And I always tell people you never get the most perfect market conditions. You never get the perfect job, you never get the perfect market. It just doesn't happen. I think what is important at this time is calmness and prudence. What happens in all-time highs is that unfortunately prudence comes to an all-time low. You get excited by what people are doing. You compromise a little bit on quality. You want to stretch yourself and take chances. You forget those rules of asset allocation. I think all the basics that you learn in this hype tend to go out of the window. And I think what is most important at this time is that prudence should also be at an all-time high if markets are at an all-time high. So if you are investing in equity, for instance, please have a very realistic return target. If you're going in thinking that the last 1 year was 90% returns and the next year is going to be like that, you're set up for disappointment. Go in expecting that large caps will give 10, 12%. If they do better, great. Go in with a five. So yesterday a guy was asking me, I want to invest in equity for 2 years. I said, it's a terrible idea. Invest for 5 years. So I think if you're investing in equity, it's not a bad time if you're investing for genuinely the long term with the right expectations. If you don't have these expectations, you should not be an equity investor, especially today because your margin of safety is not that high.
Absolutely, point well taken. Because now investors' confidence is skyrocketing. Now people wants to invest and make money very fastly. To put that in a perspective, if somebody who wants to invest today, or maybe someone who wants to add on to his existing investments, how one should approach this market as markets have touched record highs?
So I think one has to have a very strong bearing in asset allocation. And one has to understand that asset allocation is deeply personal. And once you decide an asset allocation, you have to stick to it as an individual. So, and I think you've just gone through March 2020, which helped you test your own risk appetite. Because I believe, Vasu, that risk appetite is never understood in a bull market. It's only understood in a bear market, right? I think you have to have a very strong sense of asset allocation, have a strong domestic equity allocation, but do not forget your fixed income allocation, and have a global and gold allocation for diversification. I think this basic principle cannot be forgotten, and incremental investments have to be as per that asset allocation. Just because equity is doing well, don't feel, and your asset allocation is 50% equity, don't say I'm going to be 70% equity. Don't make that deviation from asset allocation today.
Point well taken again, Radhika. So, since we are discussing about asset allocation, yes, we have understood it is very much important for any investor to have right asset allocation and right balance to their portfolio. So, how one should approach this asset allocation? Do you have a solution which can manage clients' asset allocation and have a scheme which serves their purpose?
Okay, so I'll tell you the two approaches and then I'll tell you what I like. I think there are two approaches to asset allocation. One, as you said, is to do it yourself and have a static allocation and keep changing things between equity and debt, or keep it static. The second is to use a fund or a solution. More than a fund, I would call it a solution to do this asset allocation. The challenge with asset allocation, and I use a solution, by the way, and it's not because I don't understand markets, is one, solutioning takes a lot of time. Do I do equity today? Do I do debt today? There's a lot going on in my daily life. I have to manage a house, I have family, I have all these other things doing this. And the second thing is the mind struggles. Do I do equity today when all the news is bad? How do I do it? So I think my solution has been the asset allocation fund. Ostwell called the balanced advantage fund as well. I think these are essentially products, and they are globally probably the fastest growing asset class in the world of investments, because they have some equity, they have some debt, and they do shifting between equity and debt basis some formula and basis market conditions. This is the solution I use in my personal portfolio. So I do a systematic investment plan into our balanced advantage fund. I feel that that's like, I'll tell you what it is. I was thinking about this yesterday. So on a day when I grew up at home, when my mom was not feeling so well, when we were all tired, when things were busy, something had to be cooked for lunch. And my father and mother used to cook matar chawal for lunch. It was a one pot meal, एक ही बर्तन में बन जाता था, and everybody used to eat it. And there was not too much cleaning afterwards. There was not too much effort, but it was healthy and nutritious. Now, in my husband's family, that was dahi chawal, curd rice. He comes from the south, so that was curd rice. I think the investment equivalent of dal chawal, curd rice, or matar chawal, जो मेरे घर में बनता था, is your balanced advantage fund or asset allocation fund. It's a one-stop solution. It doesn't take too much effort to prepare. It doesn't take too much effort to clean up, and broadly it works.
Great. We have great experience investing into these funds. Most of our investors have been part of this fund and they've been very much happy with this particular fund. And you've been, but tell me one specific parameter about your balance advantage fund. What makes it different from others?
I think the approach makes it different, and it's a very conscious approach. And again, I'll give you an analogy to explain this approach. We follow a trend following approach. Now, people don't understand what trend following is. So, I live in Mumbai, and if you had to go on a trip somewhere, what if you had a sunny road and a really nice clear highway with no potholes, etc.? You drive your car fast, right?
Absolutely.
But what if you had a rainy day and the road was full of potholes and there was a traffic jam and it was windy? You would slow down, right? You essentially look at the health of the road and driving conditions to decide your speed. That's exactly what balanced advantage fund does. It looks at the market health. When markets are doing well, when they're stable, when health is good, you're invested in equities. When market health is poor, you're not invested in equities. This approach is pretty unique in the industry. Most of the industry uses valuation parameters. We use this approach for a simple reason that we believe markets move in trends. You may get 12% Vasu, but you don't get it year on year, year on year. You get plus 30, you get minus 30. And for a balanced advantage fund, it is very important that in the minus 30, you give real protection, and in the plus 30, you give real participation. Beach mein, if the market is plus 5, minus 5, it's all single digits, it doesn't matter. Markets are about catching the big moments and doing them well, which is why I think BAP's long-term track record is what it is. In markets like 2017 or 21, it had very high equity exposure because of the trend following approach. In March 2020, it had the lowest equity exposure among peers, and that is what.
Superb, superb. Now, since we have discussed about market, asset allocation, let's just dive into category wise. Let's say a large cap, a mid cap, and small cap. So, if you look at how these indices have performed over a period of last 1 year, so your large caps have delivered 60%, whereas your mid caps have delivered 90%, and your small caps have delivered 120%. So, how risky is it to invest into small and mid caps, or even if it is good to invest in small and mid caps now, what should one's approach be?
Yes, there are multiple points of views on small and mid cap. Firstly, of course, small and mid cap has had a great run relative to large caps. This should not be surprising. We've been saying this as an AMC, over the period of 17, 18, 19, small and mid cap had a historical underperformance to large caps, and that doesn't persist. So what you're seeing is a reversion of that. Is mid and small cap investing risky or less risky? So there are two parts to this. Definitely, mid and small cap companies are more volatile. So there will be volatility, and your time horizons have to be expanded. If I said 5 years for equity investing, I'll say 7 years for small cap investing. However, when you say risk in mid and small cap, sometimes it also assumes that these are bad quality companies. You have bad quality large caps, you have bad quality mid caps. But mid caps as a segment are not necessarily inferior to large caps. If you're doing the right stock selection, if you're picking the right sectors and the right companies, there are just as many quality mid cap companies as there are large cap companies. They're under researched and they require different kind of research expertise. So the myth that mid cap somehow means inferior, no. More volatile, yes, which is why SIP is a superb approach, and widen your time horizon.
Super, super. Mid and small caps have been a wealth creators for many of the investors for staying long, isn't it?
Exactly. Stay long, invest systematically, and be prepared for volatility.
Super. So, since we have discussed about domestic equity, so let us just touch base on international equity as well. So, how is it relevant in this current market situation? One to have international funds in their portfolio.
And so this is a topic that this is a passion topic for me, like BAPS. And we've had international funds in our portfolio also since 2017, since the JP Morgan merger. And at that point, people used to tell me, shut down this international business, thoda sa hota tha, and nobody used to care. And in the last year and a half, I've only been answering questions about international funds. So obviously, I think interest has picked up. Now, I have been investing abroad personally since 2011. I think it is a must-have in your portfolio because just as you don't invest in one asset class in India for diversification, different countries do well at different points in time. And even though all of us are patriotic Indians, it is important to not have single country exposure. Like when I lived in the US, which is one of the finest markets in the world, 50% of my portfolio was US, 50% was global. So I think some part of your portfolio has to be global. And the core funds that you need are definitely either a global fund or a US fund plus an emerging markets fund. I mean, these are the broad areas you definitely need exposure to. However, you should invest in international funds for the right reason. The reason to invest in international funds is not because they did well last year and not because India is bad or international funds don't have risk. I also get very worried as a responsible asset manager when I see people, saying that, and we run one of the largest US technology funds in the country and one of the first, saying, oh, tech has given 100% over the last year. Let me buy 10 tech stocks, Tesla, Pang, etc., etc. That's not a responsible approach to investing. Equity is equity, whether it is Indian or global. It has risk. You have to invest for 5 to 7 years. You have to be prepared for volatility. So invest in international funds for the diversification, not just for the returns.
Fine. Point well taken, Radhika. Before we close this session, so I would like to ask you a personal question. So this is on a personal basis. So let me see if I can get a right answer from you. So if you have to pick one fund from your mutual funds today, which fund do you pick and why?
Balanced advantage fund.
And why?
It is the dal chawal, dahi chawal, matar chawal of investments. It caters to everyone and it's an all seasons fund. If I had to give you one line of investment advice, it would be do an SIP in BAP. I've been doing that for 7 years with a compounded return of about 15%, and I have had no stress. It's a stress-free way to invest.
Super. So it is very nice interacting with you, Radhika. So it's a privilege to have you with us. It is our first session that we are doing on TCA Talks with Expert series, and we look forward to many such sessions with you, Radhika. Thank you so much for taking time out.
Thank you so much, Vasu, and good luck for the series.
Thank you so much.